Okay, I wasn't aware I'm jumping the queue, but anyway, yeah, my name is Thomas Barron. I run a family office out of Auckland, and yeah, we started in 2005.
Tom, you got to speak up. You got a little bit louder. We hear you, but a little bit louder.
We started in 2005 due to a failed bank relationship. And after the dot-com bubble, we realized that we actually can perform better with managing our own portfolio than banks and some of the other fund managers. So we started to do our own research in mutual funds and individual stock investments. And yeah, so just a little bit of a background to myself. Originally, I grew up in Europe, half German, half Swiss. Yeah, I grew up in a family business. So we were running a building supply company and a property development company. I worked through the ranks over 10 years and ended up with 3 trade certificates and an honors degree in business administration, a double major in management and controlling. I then traveled around the world and met my wife in New Zealand, and life changed a lot. So then over the last 20 years, I worked mostly in operational financial senior roles, did quite a bit of M&A activities, including post-merger integrations, and also did a couple of ERP implementations with Oracle and SAP for some big corporates. And then I finally made the decision to go on my own and effectively trying to set up wholesale fund, global investment wholesale fund. So I just start to share more.
And what's interesting is, again, Tom is going to talk a little bit about macroeconomics, but we had a macroeconomic speaker yesterday from Europe. And I think that Tom and he are for the same opinion, because I went through his deck originally, and it should be very interesting to hear back what Tom's opinion is of where global markets are going. And, we heard a lot about yesterday about this kind of asymmetry and overinvestment in the United States, where I think it was 70% of all public market value is in the USA. But the USA only has 25% of global GDP. So, Tom?
All right. So that's who we are and what we're trying to achieve. So we are an active investor, and effectively we're trying to return a constant risk-adjusted return through a global market strategy. Our edge is around superior asset allocation, and we use technical and strategic market instruments, which I explain later a little bit. So this is what Marty is talking about. So the US has 4% of the global population, produces 26% of GDP, but has around 50% of the total market cap of public listed companies, which is around 60 trillion US. Then you can see on Europe and China only make roughly a quarter of the market cap of the US companies. You also can see India. India only makes up 4% of the market cap of public listed company, but makes up 18% of the total world population. So that's where we see there's probably India and the rest of the emerging market. That's where we see more opportunities than necessarily in the US. We obviously in the first quarter we had quite a big drop in the S&P 500. So from the 20th of February to the 7th of April, the S&P dropped around 21%. I mean, I almost thought today we would come back to the recent highs, but we only probably 1% away. So the equity market has fully recovered. from the April lows. So we pretty much almost square. But yeah, we do think we are a little bit in a twilight zone at the moment. So what we are looking for at the moment is the outcome of the trade negotiations, and also what impact the Big Beautiful Bill has. There are a couple of subsections. So there's one subsection which is called 899, which relates to effectively taxing of foreign investments or foreign investors. And what the bill is suggesting is that over a 4-year period, foreign investors will be taxed up to 20% on dividends. So it's definitely, I think, from that perspective, there could be an issue around future inflows in the US market if that bill goes ahead in that space. All right, next page. So here, that's what we see in April. So in April, we saw fund investors pulling out 46 billion out of long-term US open-ended funds and ETFs. So active strategies were actually bearing the brunt of it, where they had effectively 82 billion of outflows out of those active strategies. But on the other hand, a lot was flowing into passive strategies. So a lot of people are going out of mutual fund hedge funds and going into ETFs. And you can see that here on this presentation. And then here you can see the fund outflows in April, or starting in March, April, May. Effectively, those fund outflows out of the US did merely go into Europe and Australia. So you can see the two top lines this is Europe, and the yellow line is Australia. So you can see, especially from March, April onwards, the outflows actually have increased towards out of the US into Europe and Australia. The other important part is here that most of those fund outflows go into ETFs, and in those passive strategies, most of it flows between 75 and 85% flows into market cap weighted ETFs, and only 15 to 25% into equally weighted indices, which means by default, bigger companies experience higher inflows. And this has a negative impact, even like, for example, in Australia, there's a company called the Commonwealth Bank. It's the biggest bank in Australia. And because it's part of the ASX 200 and most of the ETFs, well, that ETF is quite popular, the PE ratio is around 33, 34 times earnings, and you only have a bank which has a single-digit growth perspective. So, yeah, you effectively, the bigger companies get inflated. So what are we doing about it? So we have a very well diversified asset geographically and also by asset allocation. So here you can see that a big part of our investments is in Aussie and New Zealand bonds. I will show you why in the future slides. The other big parts are in the APAC equities, is around Australia and New Zealand. It's quite a high return market and quite consistent. Then on the other side, we have here US and Canada. Mostly in the US, it's around mid-tech, high-growth mid-tech companies. In Canada, it's more mining companies. Then we have around 7% in India. We have a couple of fund manager which we are invested in, and also a couple of ETFs. And then the rest is China and emerging markets. and 5% in euro. So where we set ourselves apart to other fund managers that we use tactical market instruments and strategic market instruments. Effectively, we use derivatives to supplement the performance of the portfolio. So we use tactical market instruments, which are effectively derivatives, which have a duration of 1 to 20 days. And that's to supplement performance of the portfolio. And then we use strategic market instruments, which are effectively futures between 3 and 6 months, which we use effectively as an insurance policy for a black swan event. Any questions?
No, keep on going.
So here's our base case scenario. You can see for ease of visibility, we have amalgamated some of those investments. You see here are the Aussie bonds and New Zealand bonds. They're returning between 8 and 9% per annum. And we use that effectively as a cash buffer. So if there is a strong drawdown or we see any future opportunities where we think we can have a much higher return, then we obviously would move into that. Then here is around 50% of investments in the global markets and other fund managers. And then the gray area, these are effectively our direct investments, mostly in the mining sector and in some of global ETFs. The return on our direct investments over the last 6 months is actually already around 25% in the first 6 months. And then we have 70% on return on our tactical derivatives. So the total return here would show 13.5% in year one. We are already further ahead in the first 6 months, so we're quite positive that we can achieve those deliverables. So here you can see our performance of the tactical derivatives over the last 2.5 years. So we did pretty well. We had, in 2023, we had a little bit of a low, but we made back on that. Sorry.
So Tom, your approach is to mix public equities and some direct investments as well?
So the direct investments are in public listed companies. The other ones are in other fund managers where we see they have more research than we have. So we focus on undervalued mid-tech companies, and we also do a lot of the mining stocks. And then with this tactical derivatives, we actually supplement the portfolio and use some of those stocks.
And just Tom, just so you know, we have about 5 minutes left, but can you go into your distribution that you had? Are you investing in US public equities as well? Or
yeah, so we have around 50. It probably has gone up a little bit this month, so we're probably closer to 18 to 20% US and Canadian assets. Yeah.
And the majority of you have a large investment in Australian public equities?
Yes.
So I don't think Americans know that it's kind of deterministic that Australians have to put a certain amount of their money into the public equities on an annual basis. Maybe you can explain that.
Yeah, so Australians have a superannuation fund system where 9% of their income goes into superannuation, and obviously the superannuation fund manager direct a reasonable high amount into the equity market. So you have the equity market as such is probably a little bit less volatile than in the US. Like in the April drawdown, the Australian market actually hasn't dropped as much as the US, and even during the global financial crisis, you know, the US market went down 40% and the Australian market went down 10%. So it's this constant inflow from the superannuation schemes through this income deduction does add a lot of stability to the market. Yeah. Did that answer your question?
Okay.
Yeah.
No, that was it. Yeah. Can you just keep on going through the presentation?
Yeah.
Got a few minutes left.
Okay. Just to show you a couple of our holdings we have at the moment. So we have Life360. Life360 is a #1 global family safety app with around 84 monthly subscribers. They had a very good first quarter. So they had very strong growth from the paying circle growth, around a new subscriber, 137,000 new subscribers, which was a 43% growth year on year. They had strong operating earnings matched by financials. Revenue grew 32% and the EBITDA is around 16 million. What we like about that company is they have 82% equity, and in fact they are a global player and expanding quite rapidly with partnership announcements like Aurora, Midlife, AccuWeather. So we quite positive about that company, and it returned 35% in May. Yeah, IvyFON
Are all these companies Australian public companies or US? Or I guess do I have a Canadian one?
Kinross is a Canadian miner. IvyFON is a US company, or listed, sorry. IvyFON is listed on the US, and Life360 is listed on the NASDAQ as well.
Great. So, and I think that you're a big believer in commodities. Is that correct? I mean, we've had this discussion offline.
Yeah, so if you look at most of the global fund managers, they are all underweight commodities or materials, and that's where we're filling in the gap, where we think we can add value in the commodity space. Yeah, so the next company would be IvyFON. Effectively, it's a healthcare company focused on developing and commercializing wearable biosensing and data analytic solutions. So they had a really good result in first quarter as well. So revenue reaching 159 million, which was a 20% increase to the same period prior. Yeah, gross margin has improved from 68.8 to 60, from 66.3% to 68%. The only thing we don't like about IvyFON, they still have a very high cash burn. So for us, it's probably more a tactical positioning. We keep a close eye on it if you know how they move forward. But if they keep on cash burning like that, we probably exit out of it. Kinross.
Tom, Tom, there's not much time left, so I was hoping you could get to your closing and talk. You founded this RIA. You're in a growth stage. I just want to talk about your capabilities. So how does an American family office invest in your RIA? Do you have a master feeder fund structure? How is it set up legally?
So we have a trust fund set up in New Zealand. So effectively, I can send out a trust deed and you can have a look at it. And effectively, we're working with a platform, and then they are the custodian. So it's a unit trust fund in New Zealand dollars at the moment. We might consider an Australian dollar fund as well, but yeah.
Perfect, great. Can you give us some closing comments? We've gone over time, but why don't you take a minute for some closing comments?
Yeah, so we are in effectively in the we adding value in the mining space. We're adding value through our tactical and strategic derivatives, and we can consistently return positive returns year on year. And we think we can manage between 13.5% to 18% over the next 5 years. So what we're trying to achieve is we want to raise 50 million US to scale up our wholesale fund offering in New Zealand. So we have extensive experience in bond equities and market instruments, and we'll provide a high long-term return above 12%.
Fantastic, Tom. So I'm going to forward your deck to everybody, and we'll circulate your contact info as well. But this is really great, Tom. Again, I think this is an excellent time to be thinking about other parts of the world to be investing in. I kind of in agreement that the USA oversaturation on investments. So thank you so much.
Okay, no worries. Thanks. Cheers.
All right, cheers.